Hi guys, I'm Lewis. Welcome back to Investing Canvas. And today we're going to talk about something that doesn't get much attention, but it quietly determines your long-term success as an investor, and that's your broker. So it's not a strategy, it's not your stock picks, it's not your market outlook, it's your entire infrastructure. Because your broker determines what you can trade, how much it costs, how much leverage you can borrow, and how protected your capital is, and in some cases, who the counterparty actually is, so the other person taking the other side of your trade. You can have a great investing system, but if your broker choice is poor, it can slowly erode your returns or increase your risk without you actually realizing it. So today, I'm going to walk you through how I think about choosing a broker and what actually matters. So let's start with costs. Commissions are explicit fees that you pay to execute trades, sometimes flat fees, sometimes per share, sometimes advertised as zero, but zero commission does not mean zero cost. The second cost, often less visible, is the spread, and that's the difference between the price that you buy an asset and the price you sell it at. If you buy, say, at 100, but you can immediately sell it at 99.95, then that 5-cent gap is the cost. It may seem small, but over time, especially if you trade often, it compounds. Execution quality also matters. How close to the quoted price does your order actually get filled? This can quietly impact your performance over the long term. So when evaluating brokers, don't just ask if commission is free. Ask what your total execution costs are for assets you actually trade. So next we'll talk about jurisdiction. Where you live matters. Regulation determines what your broker is legally allowed to offer you. Leverage limits, derivative access, short selling permissions, investor protections, and tax requirements vary across countries. So just as an example, some products available in parts of Europe or Asia are restricted or illegal for retail investors in the US, such as contracts for difference. So two investors using the same global broker may have completely different permissions simply because of where they reside. In my case, I live and work in Hong Kong, which is generally a very unrestricted jurisdiction from a trading standpoint. I personally use interactive brokers, although I'm not affiliated in any way. It's simply my preference based on the cost structure, the access, and the functionality. From Hong Kong, I'm able to trade a wide range of global markets within one account. I have direct experience trading equities, FX, options, CFDs, and futures over the years, but my current strategies only use equities and ETFs. So realistically, whatever jurisdiction you're in, you should be able to trade what I trade. Aside from differences in tax treatment and leverage limits, your broker should match your strategy, not define it. Now, let's talk about leverage. Leverage is simply borrowed exposure. The easiest analogy is a mortgage. If you buy a house with a small deposit and borrow the rest, small changes in the property value create much larger percentage changes in your equity. Markets work exactly the same way. If you use 5 times leverage, a 10% move becomes 50% on your capital. Leverage amplifies both gains and losses. Different brokers and jurisdictions impose different leverage limits. But just because leverage is available, it doesn't mean you should use it aggressively, if at all. Most account blowups happen when leverage meets volatility and poor risk management. If you're evaluating a broker, you need to understand how margin works, what triggers a margin call, and how forced liquidation can happen. If you don't understand the mechanics, you shouldn't be using it. Now let's introduce something many investors ignore, and that's counterparty risk. When you buy a stock through a regulated brokerage account, you typically own the underlying asset, and the client funds are held separately from the broker's own capital. But with certain instruments, especially derivatives like CFDs, contracts for difference, your broker might actually be your counterparty. That means if they fail financially, your exposure isn't just market risk. It's also the risk that the institution on the other side of your trade cannot honor its obligations. That's why regulation, segregation of client funds, and the financial strength of the broker really matter. Your broker isn't just a platform, it's a financial institution holding your capital and in some cases, standing on the other side of your trade. So infrastructure risk is real. So next, let's talk about instrument access. Some brokers are simply equity-only platforms, whereas others offer global equities, ETFs, options, futures, FX, bonds. The question isn't which broker offers most, it's whether the broker can support your strategy. If you're a long-term ETF investor, you don't need access to complex derivatives. If you're running more advanced or systematic strategies, broader market access might matter. But remember that more tools does not automatically mean better outcomes. Then there's custody and safety. You should really understand who regulates your broker, whether client funds are segregated, and what investor protection schemes apply to your broker. Your broker holds your capital, remember. This is counterparty and infrastructure risk, and it deserves serious attention and consideration. And finally, have a little think about your broker's platform design and the behavioral risk associated. Some platforms are designed to encourage activity, bright colors, notifications, dashboards. Others are institutional and utilitarian. Personally, I prefer boring. Investing success usually comes from discipline, patience, not stimulation. Your broker should quietly execute your plan and not gamify your risk taking. So just to bring all I've said together, choosing a broker is not glamorous, but remember it affects your cost structure, your regulatory environment, your leverage exposure, your counterparty risk, your behavioral tendencies, and your access to markets. It is foundational. So with that said, don't rush it, don't choose based on marketing, and don't underestimate how much this decision will shape your investing journey. Infrastructure shapes outcomes. Thanks for watching, and I'll see you in the next one.